Hey everyone, and welcome back to another video for today. So on Friday, as you can see, the market was a bit shaky, right? Well, the market was a bit shaky. Nvidia down 3.3%, Oracle down almost 6%, Broadcom 3.6%, AMD 3.5% down, Tesla down 3.5% as well. We have companies here on the watch list. Marvell is down almost 19%, Duolingo down 7.7%, but we do have also green names, right? Iron, we've covered that yesterday right after the earnings report. Iron up 15%. The stock was actually up more than 20%. United Health up 2.5%. Rocket Lab is green. Google is green. And even PayPal is holding up a little bit. But in today's video, I do want to touch on, well, what comes next, right? September, we've talked about, September is a month where usually the market goes down. But then again, August is also usually a month where the market doesn't really go up that much. And yet, as you can see, over the past month, it has been quite good overall. I'd also like to touch on Alibaba because Alibaba was also one of those stocks that today was up quite significantly. Same with Affirm, and I will touch a little bit on Marvell as well throughout this video. If you enjoy this type of videos, of course, hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So Alibaba, as you can see, up 13%, well, close to 13%. Now, year to date, the stock is up 59%. Alibaba is a stock that I do own. It's a stock that I started to buy towards the end of 2024 because, yes, in my eyes, it was just too cheap to ignore. I did feel like there will be a switch from just focusing on US equities towards maybe Chinese and European names. And that's exactly actually what has happened, especially in the first 2 months of the year. Stock was up over 75% at one point, and now we're back to being up close to 60%. I still view this as one of the undervalued names at the moment. I fully understand that, yes, this is a Chinese company, and so it will always get the Chinese discount on the stock market because, yeah, when you look at this company, yes, it's not growing as fast as before, but there are some segments in the business, such as the cloud segment, that are growing much faster than before and actually accelerating. I still think that this stock should be going much, much higher. Now, I don't control the market. I don't control the stock, although some of you do think that I do. I wish I did. But Alibaba is a very, very good company that, yes, maybe it will never get the respect of the market, but that's fine. Year to date being up 60%, I'm happy with that. And so if we look at the highlights for the quarter, total revenue up 10% year over year, right? This is also excluding SunArt and InTime. Alibaba China e-commerce group up 10% year over year. Cloud Intelligence group up 26% year over year. And then the international one up 19%. They undertook a strategic combination of Taobao and Tmall Group, Elmi and Frigi into Alibaba China e-commerce group, transforming their value proposition into a comprehensive consumption platform. Their quick commerce business achieved key milestones while contributing to the 25% year-over-year growth in the Taobao app monthly active consumers in the first 3 weeks of August. As for the cloud business, that delivered accelerated growth as segment revenue and revenue from external customers both grew 26%, with AI-related product revenue maintaining triple-digit growth for the 8th consecutive quarter. As for Alibaba International Digital Commerce, right? This isn't AI data center. No, it's Alibaba International Digital Commerce. That delivered solid progress, approaching break-even while sustaining strong growth momentum. Now, one number that we are all focusing on, of course, is the free cash flow one. And free cash flow, as you can see, has been an outflow. Why is that? The significant decline was primarily driven by two key factors. One, an increase in cloud infrastructure expenditure, and two, a substantial investment in Taobao Instant Commerce, which we're going to touch on in a bit. If we look at the international group, right, this one right here, you can see we're very close to reaching adjusted EBITDA break even. And that, of course, is growing much faster than the Alibaba China business, but of course, it is also much smaller. But the fact that it's still growing 19% and we're close to being break even here is a very, very positive thing. When looking also at the cloud business, growing 26%, and that growth has been accelerating. Now, of course, year-over-year comparisons were quite easy, but that's also something to be proud of. Moving on to some key segments here. So they launched Taobao Instant Commerce. What is that? That's a service on the Taobao app that launched at the end of April to meet consumer needs for on-demand delivery across a wide range of product categories, including food, groceries, electronics, and apparel. This initiative strengthened the Taobao app leadership in China's e-commerce industry. Their significant investment in quick commerce focused on building consumer mindshare and business scale, which contributed to the 25% year-over-year increase in monthly active consumers on the Taobao app in the first 3 weeks of August. As part of the quick commerce strategy, they expanded their product offerings and front warehouse coverage for non-food categories. Now, if we look here again at the segment adjusted EBITDA, that did decrease 25%. That was primarily due to the investment in Taobao Instant Commerce, as well as their user experiences, user acquisition, and technology, partially offset by double-digit revenue growth in Alibaba China e-commerce group. Now, if we look at the Cloud Intelligence Group, they said the following thing with regards to the increase here. That was primarily due to public cloud revenue growth and improving operating efficiency, partially offset by the increasing investment in customer growth and technology innovation. You've probably also seen a lot of reports that came out that Alibaba is going to work on their own AI chip to, let's say, compete with NVIDIA or offer a different service or a different option to NVIDIA's products. Of course, I don't think it will be highly competitive right from the start. But of course, whenever this thing gets announced, it is quite exciting for the company, for the stock. And again, Alibaba does get you not only the exposure to e-commerce, which, okay, is not growing that fast anymore, overall, international and China, but it does give you the fourth biggest cloud player, right? You have AWS, you have Azure, you have Google Cloud, and now you have here Alibaba Cloud. And I think the price that you're paying for Alibaba is definitely not that expensive. Looking at the stock right now, it's quite interesting that we are exactly where we were 3 months ago when the company reported their quarterly figures. Can it stay above that point right now? I mean, previously the stock did drop after it reported. Now the stock increased after it reported. So I guess we're in a better position right now. Now, of course, let's see what happens in September, rate cuts or not, trade deals. Let's see what happens with that. September market downturn, who knows? But right now, I think it's in a good position. Moving on to the next company, and that's Affirm. We actually did talk a little bit about Affirm when we covered Sezzle a couple of days ago. Affirm at one point today was up 10x from its 2022 lows. Yes, incredible, right? Still, it was up 10.6% on Friday. It's a company worth $26 billion over the last 3 years. It's up 248%. Year to date, stock is now up 41.6%. It is a very good company with very, very good leadership as well. All in all, revenue increased 18% year over year. Net income increased 15%. Diluted earnings per share of $2.50, up from $2.15 a year ago. Operating margin did improve by 0.5%. Looking at GMV growth has been accelerating, let's say, almost every quarter since the March quarter of 2023. One dip here in the June quarter of 2024. But look at the acceleration that we've got this quarter, up 43.6% year over year because of the weaker quarter, same quarter last year. As for active customers, transaction per active customers, and the growth in active customers, the growth here you can clearly see, we have seen a nice acceleration in growth since the March quarter of 2024. As for the other two metrics here, up and to the right. And so right now, with regards to revenue growth, yes, that is decelerating, right? They only grew 33% year over year. But then again, it's 33% on top of a quarter where they grew around 48%. So all in all, I mean, Affirm, if you want me to do a specific video about that, I don't think you would, because I just talked about it a couple of days ago with Sezzle and with the other players. Affirm is, it gives you the exposure to buy now, pay later. But if buy now, pay later does become quite big and does replace credit cards in some pockets of the market, then I do think that Affirm will be the huge winner here. Why is that? Management is extremely important. Moving on to the company that probably took the biggest hit today, and that's Marvell. Marvell is down 18.6% back to $66.5 billion. Year to date, it's down now 44.5%. Yes, the stock recently, especially from the April lows, has been making its way back up, but then, yeah, right now, stock is down. So what exactly has happened with the quarter? By the way, I don't own Marvell. I don't own any of the, well, either Marvell or Broadcom or any of the equipment makers such as ASML, Lam Research, Applied Material, and all of that. My semiconductor exposure is, of course, AMD, Intel True Options, and Micron. And so what happened this quarter with Marvell? Net revenue increased 58% year over year. Apologies for before, I don't think the page loaded correctly. GAAP gross margin 50.4%, non-GAAP 59.4%, GAAP diluted income per share of 22 cents, and cash from operations $461.6 million. Guidance is the reason why the stock took such a huge hit, because guidance was not as good as expected. So for the third quarter, they expect net revenue to be around $2.06 billion plus minus 5%. Market was expecting better than that. They did say that the company's custom AI design activity is at all-time high, engaging in over 50 new opportunities across more than 10 customers. The data center segment in particular was a key contributor, growing 69% year over year and 3% quarter over quarter to $1.49 billion, representing 74% of total net revenue, which you can see right here since, I would say, the February or May quarter of 2024, it really started to dominate, right? It became a huge part of overall revenue and, of course, growing faster than the rest. Revenue growth for a company has, of course, started to accelerate back here, May 2024. We've seen that acceleration in growth. And, of course, the year-over-year comparisons are quite easy when previously that was negative growth. Now the upcoming quarters, that's when the year-over-year comparisons are becoming tougher. And so when that's the case, when maybe also the company faces some headwinds or just does not compete as well as the rest, then I guess this is what happens with a stock like Marvell. And so right now, stock is down back to levels not seen since the start of June. RSI is going to be very low at the moment, but yeah, you can see that this is not the nicest candle. It seems like there were not that many buyers, but then again, as we've seen, Friday was not really a great day. But then again, I don't think we should start panicking, because the last week's performance is still very nice, right? The last week's performance still very nice for a lot of the names that we do cover. Yes, Oracle is pulling back a little bit, but it had a very nice ride already over the last couple, year and a half, almost 2 years or so. So a little pullback. And then year to date, other than Apple here, or yeah, of course, the software players, ServiceNow, Salesforce, Adobe, Accenture, and Tesla a little bit right now, most of the names that we cover are up significantly. So again, we can have, that's the thing right now with the market that we are seeing today, and actually over the last, I would say for sure over the last 2 years or so, we have pullbacks, right? We have been in a bull market since 2023, right? 23, 24, and now until now 25, I think we're still, of course, in a bull market. But over the past 2.5 years, we had crashes, flash crashes though, right? We didn't have a 2022 where it really took almost the whole year until we started to go up a little bit. No, now we really have flash crashes. It's 1 day, 2 day, maybe 3-4 days or so where things go down consistently. But as we've seen in April, or the DeepSeek drama, those are a couple of days where a lot of these stocks lost 10, 15, 20, sometimes even more, right? And Nebius was down 38% or so back then. So we do have crashes. For people that say, oh, we never have pullbacks, we do. We already had a lot actually of those pullbacks in a lot of these tech names and semiconductor names. It's just so that these pullbacks don't last long, right? These are scare pullbacks. These are pullbacks based on external factors. Of course, external factors can sometimes impact these companies. But right now, it seems like it does not impact them that much. Could of course impact them in the future, but I still think that we can stretch this bull market for a long time. We still have rate cuts coming, right? Whether, of course, we would love it if the rate cuts are not forced, right? Forced rate cuts means that the economy is just terrible and the Fed just needs to cut rates by 50 basis points or, of course, 100. That would be worst case scenario. I still think we're going to get 25 basis points cut in September. I also believe that we're going to get a second one. So we'll have 2 cuts still in the back half of this year. You might think I'm crazy, but I think that's what's going to happen. Remember, right now, it's only 2 rate cuts for 25, 1 for 26, right? So even if we only have 1 for 25, we might have 2 for 26, depending, of course, on the economy and the tariffs, on inflation and all of that. But if you can stretch the rate cutting cycle, I don't think we're going to 0, right? But if you can stretch that rate cutting cycle, since we are still quite high, you can stretch the bull market. And so bottom line, I know I did not buy anything on Friday. I have time, I have patience. If we do see a couple of extra days of red, then of course, I mean, you know my list. This is basically the watch list. A lot of these names I do own, but most of these names are just back to prices not seen since the start of the week or just a couple of days ago. So it's not like, oh, I'm in a rush to buy. No, I bought a couple of names last week. Maybe next week I'll add a little bit more, right? With Nebius, I have 0 issues averaging up. I said the same thing about Iron, actually. Iron, I will probably average up as well. With CoreWeave, still a starter position, but then again, it's in that secondary portfolio. And so, yeah, I will be adding. I don't care if September historically has been a bad month. Give me better deals, right? Who's going to complain? Who's going to complain if we can buy great companies at better prices? But yes, I know that some names are stretched. So, okay, give me those flash sales again, and I'll gladly take them. So, all in all, that's about it for me in this video. Hope you're all having a wonderful weekend. We'll see each other in the next one. Bye-bye.